So if we follow the standards process, it says the first thing we need to do is identify the risk of material misstatements, which is what we've just done. We have looked at the understanding of the entity and its internal control, and through that we have been able to identify the risk of material misstatement because we were able to identify their inherent and control risks. My next step is then to consider if that risk affects the financials as a whole. So what does it mean? It means, does that one risk have the potential to affect all or a majority of the class of transactions and account balances in the financials? Or does that one risk have the potential to affect any class of transaction or account balance, and you can't identify where specifically? So think about what we've just done. If management integrity is lacking, we pick up through reading the information that the control environment is weak. They are not creating an environment or an atmosphere of where people should be sticking to controls. So their integrity is questionable. Where in the financials do you think they would manipulate because their integrity is questionable? Anywhere. They could have manipulated all, they could have manipulated a couple, they could have manipulated the random ones. So because there's one risk that has the potential to affect anything, and I can't specifically pinpoint where, then we've got a risk that affects the whole financials. But if we've got a risk like the accountant doesn't know what the financial reporting framework is, so he just puts together his own amounts for the figures in the financials, then I can pretty much be sure that all or a majority of those class of transactions and account balances would be wrong because he doesn't know what is right. So I've first got to consider if that risk has the ability to affect multiple balances and transactions. Then, once I have considered if it's a risk that affects the financials as a whole, I need to consider what potential assertions are affected based on this risk. And guys, you can see there, I didn't say only if the answer to question 2 was yes, do I do this? Or if it was no, do I do this? So my step process is first find a risk of material misstatements, then look at if that risk could affect the financials as a whole, and irrespective of my answer there, move on to 3 to see where in the financials could there be a misstatement. Is it going to be related to specific transactions or balances, and therefore I will be able to link it to the assertions for that balance or transaction? Or has point 2 said to me it affects the financial as a whole, and I'm looking at this one which tells me I don't know which balances or transactions could be misstated. In which case my answer to 3 would be I don't know. So what we need to see here is, if a risk affects the financials as a whole, it is going to affect the majority or all of the class of transactions or account balances, which means I need to then go and get specific once I've identified that. If I say it doesn't affect the financials as a whole, the fact that I've said there's a risk of material misstatement means I must then be able to say which specific assertions are affected. So I might skip to I might say no to 2, but definitely yes to 3. But I also might say yes to 2 and then yes to 3. So a little bit more detail here. Risk at the financial statement level, guys. This risk pervasively affects the financials. Pervasively means as a whole or affects many assertions. It's a magnitude. It's a gravity measure. So it's a lot. A risk at the financial statement level, I'm saying there are lots of balances or transactions that could be misstated as a result of this risk. What is our responsibility? Obviously, first and foremost, we need to identify this risk. And then once I have identified, I have to assess the nature and the extent of the pervasiveness so I can really see where it impacts in the financials. And I need to consider if it affects specific assertions. And then see the impact on that assertion as a result. So, the example that we've used a couple of times already, if they are going to get a bonus based on profit, that is a risk at the financial statement level because all income items could be overstated and all expense items could be understated to get a higher profit. So I see the effect of the pervasiveness on my financials and I bring it down to these class of transactions and how I feel they could be misstated as a result of that risk. So that is my assessment 2, point 2 done. Now I want to discuss or consider the effect at the assertion level. So now I come to point 3 and I say yes, revenue occurrence is a risk. Other income occurrence is a risk. My expenses, whatever expenses there are, depreciation, completeness is a risk. Or accuracy with the calculation to make it lower. Repairs and maintenance. I think maybe classification is a risk. I think they might classify a repair and maintenance as a PPE enhancement and capitalize it instead of expense it so that they decrease repairs and maintenance expense. So I assess at the financial statement level and then I go and see where does that risk affect specific balances and transactions, and I start to link those to assertions. We're going to look at the assertions now, so don't worry if you're going, what? I don't remember these. The details coming. So, once we've done risk at the financial statement level, we move on to the assertion level, and this is where the risk affects the specific class of transaction or account balance or disclosure in the financials. So we need to go and take the information that we understand about the entity and its internal controls and pick up which class of transaction has a risk, which account balance has a risk, and where are there risks with regards to the disclosures in the financials. And then once I've done that, I have to go and assess the likelihood and the magnitude of this misstatement. So the likelihood, is it actually going to materialize? And the magnitude, the amount, what is that figure in terms of the misstatement? And I only assess control risk if I want to test the operating effectiveness of the controls. So when we're looking at the risk of material misstatement at the assertion level, I pick up a risk and then I say, that inherent risk, what is the possibility of this materializing and what is the potential misstatement if it materializes? And I focus on that. And if I want to test controls because I obviously think the controls are going to work, then I will assess the control risk. But if I'm not at all interested in testing the controls, then I'm not even going to assess control risk. And the risk of material misstatements is going to be based solely on this initial inherent risk. Okay, we are going to get into this next, but before we do, I just want you to see if we can identify a risk at a financial statement level from a risk at the assertion level. So I just want to see if you can make the connection, and then we will get into the detail of assessing your risks at the assertion level. We'll look at the assertions, we'll see how you determine the magnitude and likelihood of a misstatement taking place. I also just want you to highlight this right now. Appendix 2 in ISA 315 is amazing. It's got loads of examples of risks at either level. And so if you're struggling to find risks, that's where you need to go to help you to identify risks of material misstatement. So now when you do question 2, if you can't find risks, go and open Appendix 2 and see if you can see any similarities. So guys, I'm going to give you 5 minutes for this. Again, no reading time, just work through each and see if you can pick up which is a risk at the financial statement level, which is a risk at the assertion level, and which you can actually link to both.